Hey everyone, Mayhem here. Going to talk a little bit about how I approach trading futures and some of the things that I look at to find coalescence. Now I see that got some folks out here on YouTube. Thank you so much for tuning in. I know I took a little break from here and I'm back. I'll be back every Tuesday at 9 a.m. Eastern to talk about what I'm looking at in the market. So appreciate you all tuning in. You can set your calendar to next week at Tuesday, 9 a.m. I'll be back. But first, before we dive in, let's talk a little bit about kind of how I got started in this game. So I am a self-funded trader. I've been trading my own money since 2005. Started investing in 2006. Did some of my first trades with money I had borrowed from my father. I started working at a young age, but I borrowed because I couldn't, as someone who was under 18, trade the market myself. So I bought some Yahoo, I bought some Amazon. They doubled the next day. I didn't know exactly what was going on with that. Didn't really, let's say, understand it, and so I stepped away because I felt like at that time, if everyone could double their money in the market, then why would anyone work? Right? If you could double your money the next day, why would anyone work, right? You just go to the bank, borrow some money, put it in the market. So even as a young person, I had some sort of, I guess, need to understand a little bit more about how this works before I just sort of sunk my teeth into it. And of course, this was during the dot-com mania that was happening, where those stocks doubled. So it was very unusual. It was not how things should trade. And so I took some time to study, to step back, and I started trading my own money in 2005. Opened an account at Scottrade, started trading stocks and then equities, and then eventually worked my way up to futures and Forex and, moved on to interactive brokers. But I've been very passionate about learning about technicals, macro, how they come together, and then finding different areas of convergence that can increase my confidence in a trade. So here's a little bit more about me. You can find my work at Traderade.com. That's where I'm talking about education. I build trading tools, including one that's coming out on Bookmap soon that we'll talk a little bit more about later. And I also share trading ideas. One of the ones I just exited was Zim. We got in that one just over $8, just got out at 14.66 yesterday. There's been a lot of squeeze trades like this that I've been eyeing, where there's a catalyst, where there's a setup where a lot of people are betting against it. Mara was a near triple in about a month that we identified and traded. And that's exactly the kind of stuff we do at Traderade. We help people get better at being traders, but we also identify possibilities in the market, and we have different unique tools. And one of those I'll show you. Macrovisor is where I help people learn more about the big picture and how that translates into long-term investing themes. So we've got a number of good stocks that we've been talking about there. Nintendo has been one, F5 Networks, and others that we've identified over time. And this is all about kind of taking the momentum element and the bigger picture, combining them to understand how that can drive better returns and uncorrelated returns with the broader markets. You can find me on my own YouTube. That's Mayhem for Markets. That's youtube.com/@Mayhem for Markets. I just released a video about the psychology of trading that I highly recommend checking out regardless of your skill level. We can always learn and improve. And this video is all about being sustainable over the long term, the mindset and some of the practices that can help with that. And then finally, if you'd like to get up to 40% off of Bookmap, go to traderade.com/bookmap. That's traderade.com/bookmap. And you can get up to 40% off on your plan. So let's read the fine print. This is why everyone comes to watch the video, so they can hear me read the fine print here. So, all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. So, now that I've read that, everyone can go. That was everyone's favorite part, right? Just kidding. So let's talk a little bit about options positioning across the S&P. Right now, we've got a huge amount of open interest at 5,000. Now, this is open interest that is for later this year and next year, so it's not exactly imminent. So it doesn't have the same kind of magnetic effect that it may otherwise. But we also have a pretty good amount of open interest below us at 4,900, which is likely to act as support. I don't see the market necessarily pushing below there without a powerful catalyst for that to happen. So that's just something to contextualize. Obviously we have some potential catalysts for moves in both directions this week. We have major earnings reports coming out, including today. We've got some of the majors, basically $10 trillion or the Magnificent Five reporting this week. And that's going to be a pretty big deal to keep an eye on. Today we have Microsoft, AMD, Alphabet, or everyone really knows them as Google. I think those are going to be the most important earnings that everyone's watching. And then, of course, on Thursday, we have Apple, Amazon, and Meta, as well as some other popular stocks like Atlassian. So this is the biggest week of earnings for earnings season. We've also got the Fed tomorrow. Got a lot of labor market data, including later today, 10 a.m. We've got JOLTS coming out. Right? So there's a lot of moving parts here, and we'll talk a little bit more about what I'm eyeing as we go through. But options positioning at least suggests that SPX 4900 or ES about 4924, that could be an area of potential support here if we see this pre-market drawdown continue into the cash session. So let's talk a little bit about positioning and flows for a moment. We are in the greed zone in terms of how people are expressing themselves. The ratio between high beta and low vol strongly suggests a very, very powerful appetite for risk here. Now, that's fine in the sense that we are in a place where, risk taking has done well. People who have been taking risk in high beta stocks, particularly these, large cap and mega cap growth stocks, have done very well. At the same time, when the chart tends to get down to this ratio, like we saw at the end of 2024, sometimes we do see some corrective impulse, some rotation back into some more safer parts of the market. So this is not an area where, for swing trades, I'd be looking at adding long. As so much I'd be looking at potentially raising some cash just because of these dynamics. Now, obviously, it depends on what factors and sectors I'm long. But if I'm long high beta tech, I'm probably going to be more interested in taking some profits or potentially hedging. At the same time, some of the lower volatility defensive names, because of this ratio, could start to become a little bit more attractive if their individual technicals set up well and there's a catalyst. So consolidated equity positioning, this one comes to us from Deutsche Bank. It shows us that we're in quite a long market, but we're not stretched long from positioning, right? This is one measure. There's several different measures. Different banks have different client compositions, so you're going to see different lenses on this, right? Like we saw NASDAQ positioning was at or near 5-year highs. We saw aggregate positioning across Goldman's equity futures is at like 5 or 6-year highs. So it depends on where you look as to what you see. But this particular measure at least suggests we're not super stretched, right, in terms of positioning. And that's good. We can contextualize that with some of the data that I'm going to show next as well. So total net call volume, it is on the rise. This is showing us calls minus puts. Now, obviously, we don't know if they're buying to open or selling to open, but most call volume is going to be buy to open. So this tends to be a sign of a more bullish impulse. Indeed, last week we saw the equity put call ratio dip below 0.5. That was telling you there was more than 2 calls for every put being transacted at the CBOE. Again, often a sign of some degree of optimism or euphoria when you see that. And we have skew here. Skew is on the rise. What this is indicative of is a better hedged market, right? So we saw the net positioning. That's important to contextualize, but we also have this measure that's telling us this is not a market that is only concerned about upside. There is some effort to hedge against downside risk in this market. So I'm going to take a quick pause. I see there's a comment in the YouTube. Let me check on that. So BTS, I don't have Sierra chart on this system. I use Bookmap and Motive Wave, but if you want to tell me a little bit more about what you're looking for, perhaps next time that's something I can look into. But back to this screen. So for folks that may not fully appreciate what skew is the difference between the amount of premium being paid for puts versus calls on the S&P. This index is $ skew on stock charts. It's a great, easy way to get a sense as to whether the market is, really, really euphoric, or whether there is a little bit of insurance happening here. So, the greed chart shows greed, but at least we're not greedy without appreciation for downside risk. That's why this chart is helpful, because now we're back in that period of time where we're going to start to see some of those passive flows from the decay of this same positioning actually bidding up the market. So what Jem Carson is talking about when he talks about Vanna and Charm flows, this decay of Delta and Theta bidding up the underlying, which would be S&P futures, as dealers are unwinding some of those hedges. We have a lot of fuel for that. This is a market where the hedging, is enough that it could help to push that sort of passive bid, or that buffering from that decay of the value of these put positions. So we have the NASDAQ McClellan oscillator on screen here. It's showing that we've moved back into positive momentum and breadth in the NASDAQ. I'm focusing on the NASDAQ a little bit more because it has been the leader. It tends to lead intraday, over the week, over the month, over the year, on multiple time frames. So I like to focus on it for momentum. And we do see momentum starting to turn back positive in the NASDAQ again. So it's something we should contextualize. Obviously, there's a lot of moving parts this week with the amount of tech earnings that we have, not just from the so-called Mag 5, but a lot of other companies reporting this week. So I think that, this could go either way. You have tails in either direction. That is to say, you have the potential for larger moves in either direction on a week like this. And the NASDAQ number of stocks above the 20-day moving average has pushed higher. It's now at just above 54%, 54.48. This is another sign of a positive push higher in breadth. You've got more issues in the NASDAQ that are climbing above their 20-day moving average. This is not in any way an exhaustive reading yet. That tends to be over 60. So this is still healthy. It still gives you a sign that over a longer time frame, there is more constructive price action happening here. And that's supported by some of the other data we're seeing as well. This next chart is the number of NASDAQ new highs versus new lows. And what you're seeing here is 158 new highs in excess of new lows in the composite over the last week. So that's going back to last Tuesday through the present. That's showing us again that there is constructive price action, that there are more highs happening in the NASDAQ than lows, which is what you want to see in a market that's gracing or making new all-time highs, right? You want to see that push from a broader number of issues also making new highs. So JOLTS is going to be the key data point today. That's coming up at 10 a.m. I think that's really going to be what drives any kind of volatility in this market. And there's really two ways to look at JOLTS, right? So the expectation is about 8.75 million. A number that's much higher than that, that is to say, if the number of job openings is much stronger, then we would probably look for an upside move in rates and a downside move in risk. So that would mean bonds and stocks dropping if JOLTS is meaningfully higher than expected. For me, that magic number is probably 9 million and above. The other side of that is if it comes in at 8.5 million or below, that would be something that I think you'd see rates drop and risk get bid further. Okay? So coming into this, we're looking at a number that if it deviates around 250,000 either way, that could be a catalyst. Now, this is not to say that we're pricing in the macro immediately. This is to say that there is hedging into this. And how the number plays out could have a big impact on that hedging. So we're in a well-hedged market environment going into JOLTS. We want to take that into consideration because if this number comes in at expectations, you could still have a decent bid as some of those hedges are unwound potentially. But if it comes in much lower than expected, I think you'll have not only hedges unwound, but folks buying in under the presumption that you're getting more data from the labor market, giving the Fed an all clear ahead of their meeting tomorrow. Right? Because right now, the Fed is meeting. They meet for 2 days. They meet on Tuesday and then Wednesday, and then they come out on Wednesday. They make their decision, and then there's the press conference with the chair, which in this case would be Powell. So right now, they are still deliberating. I don't see any chance of any cut tomorrow, by the way, like 0%. But what I do think is important is how they contextualize policy moving forward. Are they going to talk more about, we're done with the hikes, or are they going to leave the door open? That's going to be pretty important for how the market reacts, and so will Powell's demeanor and the way he approaches policy and even the balance sheet during his press conference. So let's move on to some charts. This is a chart of the S&P 500 futures. Now, obviously, it's not current to the minute, but I took this, about 30, 40 minutes ago. And it just looks a little bit stretched here. It doesn't look bad. Momentum is very much on the side of the bulls here. We're above the 20-day moving average. RSI is a little bit exhausted. Sorry about that. Just went back. I'm going to push that back forward here. But everything on this chart from a momentum perspective looks pretty constructive. RSI did get a little bit overbought, but overbought in the context of an uptrend is not that meaningful. Things can stay overbought for quite some time. So it's just something to take into consideration when, you see all these folks saying, RSI is saying we're overbought. Well, if you're in an uptrend, that's not that meaningful. It's actually much more important in an uptrend to see RSI oversold as a potential area to add to a position. Just like during a downtrend, seeing RSI is overbought can be a good place to look at shorting or, adding to a short or whatever, however one may be trading that type of environment, right? Maybe if you're counter trend trading, taking off that long. But I like to add some nuance to these momentum oscillators because I often see that the way they're used is it lacks some of the context for how the underlying instrument is trading. And you can backtest this stuff, so don't just rely on what I'm saying. And obviously, different instruments have different personalities. I'm contextualizing this based on my experience with the S&P. You might find it behaves completely different with whatever your favorite trading instrument is. Speaking of favorite trading instruments, here is the NASDAQ, which has really become everyone's favorite trading instrument. This is the futures contract for the NASDAQ 100. And like the S&P, it does look a little bit stretched, but it doesn't look terrible, right? It still is very much in favor of the bulls. We're above the 20. We're above the value area, so you could say we're a little bit stretched if you're looking at this from auction theory. We have kind of traced back down below that, so-called overbought condition on the RSI that I was talking about. Overall, it doesn't look bad. It just looks like maybe we get a little bit of a retrace to the lower end of the range here before we move higher. But overall, this is a week full of so many catalysts that it's hard to get any real strong sense of directionality before we see how some of these things play out. Earnings, the Fed, labor market data being the most important catalysts. Now, this is a price chart of crude oil. This has been on the minds of many. We are back in a very key area here between 75.50 and 76. This is kind of going to determine whether or not we are really reversing and starting to break out. We have to hold here, we have to build, and we have to grind higher. Now, RSI and, the overall momentum in the trade is in favor of that. We did have this breakout, as you can see from the blue line. We're above the point of control. So bulls still enjoy odds in their favor here. But this is also a market where there have been a number of different catalysts, and it just couldn't get much of a bid. So I'm not terribly optimistic. I am constructive. I like energy stocks more than I like oil itself here. So if I want to express a positive opinion in oil, I'd rather get long some of these energy stocks or even the sector ETFs like XLE or XOP than actually getting long crude itself. And that is because I've seen more relative strength in the stocks and in the sector as a whole versus the commodity, which tells me I'd rather have my money there where the strength is. I'm not really looking for that mean reversion trade. Now, on the other side of this, if we can really build here and move above 76 and continue pushing above the most recent high, I think $85 is in the cards for crude, right? Just looking at that over the next several months and with the sort of catalyst we have behind it, that's where my thought is. Now we're about just over 7 minutes away from the open, so I'm going to get through the rest of these charts and then we're going to go right into Bookmap, where I have a number of different instruments that we'll take a look at, including everything I'm covering and more. Next chart we have here is gold, and gold's not really doing much. Now, the price action that we've seen recently is encouraging, right? We did have this breakdown from an uptrend. Now we're in a mode of what I would consider to be consolidation. And you can see that trading range we've been in for most of 2024. We did just break above the 20-day moving average. We do see RSI perking up. We're above that point of control as well over this time range on the chart. So it's starting to look a little bit more constructive, but I'd like to see some build here. I'd actually like to see gold trading above 2060 on a closing basis before I get more constructive about this potential bottom. But I do think that we're starting to see some signs here that, you know, this consolidation phase wants to lean higher. So let's see where it goes. There's no trade in here yet, but maybe today's price action gives us a clue. And we've got the 10-year note futures here. It had a nice little breakdown from its uptrend that started in October. Now it appears like it's almost trying to bull flag here. Obviously, we have to see what the Fed does tomorrow. That'll probably give us a pretty good idea as to what happens with rates, similar with labor market data, including to some extent JOLTS today. You know, it can have an impact on these longer end rates. So that, and then of course we get from the Treasury Department the composition of their debt issuance, which will also be important for markets to digest. You know, more longer duration tends to be more of a liquidity vacuum, more bill issuance tends to have a very de minimis impact. And here's the US dollar index. It's just sort of grinding up against this point of control. It did break out of its downtrend. RSI and, you know, above 50 and kind of consolidating, but also above this 20-day moving average all suggest that we could still see some upside from here. But again, caveat being the Fed and labor market data. Those are going to be really important for the dollar and for the biggest cross pairs, right, which are the yen and the euro, which I watch closely on Bookmap. Those contracts are pretty liquid. They can be pretty interesting. So that's everything I have on my presentation. We're going to now switch over to Bookmap. And we'll go over to the SPOOs here, or the ES contract. Now, before we dive into, you know, kind of what I'm seeing on screen here, I wanted to just show you these labels on the lower right. These are added in from my SPX Options Visualizer. This plugin will be going live on the Bookmap Marketplace, I believe this week. And this data is refreshed throughout the cash session when CBOE options are trading every minute. So once we have enough volume, the labels populate, and they can be pretty helpful for seeing where there's these convergences between resting liquidity, where price is currently trading, and where there's options flow and positioning, right? You put it all on one screen, it becomes a pretty powerful tool. So on screen, we do have the S&P. We are getting a little bit of a bid back here pre-market. We can see as I'm zooming out just into back to 8 a.m., it's been a bit of a choppy trade, right? This hasn't been a particularly directional trade pre-market. We're just sort of grinding up and down. We did get some economic data not too long ago. Let's see how that came in. So we got Case-Shiller home price month over month, and the actual number was actually home prices falling 0.2%. Forecast was for rising 0.2%. Year over year number came in just slightly below the forecast at 5.4 versus a forecast of 5.9. So nothing too major there. Let's just take a look At HPI also came in pretty much within expectations at 0.3%. So not too much of a reaction to the data. That data point, as you can see with my crosshair, came out at 9 a.m. And we see just a little bit of a bid towards some of this resting liquidity up here. You've got over 600 contracts, about 651, just hanging out this resting offer. You also have a pretty chunky resting bid at 49.40. Let's take a look at the NASDAQ here. The NASDAQ, obviously the more volatile cousin. Similar look though, kind of just chopping around. More downward directional bias from the NASDAQ overall. And I'm going to zoom these in just a little bit. I like to keep about a half hour on screen, not too much more than that. Just my own personal preference, obviously, whatever works for you. Good morning, Demo Trader. How's it going? Let's take a look at crude. We're building here from the lows. This is a great look. It's exactly what you want to see if you're bullish of oil here. So we do have that build off the lows in crude. You know, I think that, and I might be early on this, I do think crude is bottomed. Obviously, I need to see it close above 76 again. We seem to be on track for that outcome. Let's see how we trade this today. But this should be bullish for energy overall, if we can continue this momentum. Gold, similar look, just grinding higher here. Up about 14 bucks really from these lows, 13. Not the most liquid trading though. This contract is quite illiquid overall. Here's our 10-year note futures. This one doesn't tend to move much. There's so much liquidity in the book. I mean, contrast this with gold. You've got 600,000 order book depth, right? And gold, you've got 300, as in just 300. That's quite a difference, meaning it takes a lot less volume to push gold all over the map. And you can see that liquidity here in the treasury contract, those thousands and thousands of contracts, particularly right around price. So it does take a decent amount of money to push rates around. This is the 30-year bond futures contract. Similarly, quite liquid, not as liquid as the 10. This one's got about 160,000 contracts. And then this is the Euro futures contract, because it is helpful to watch how a lot of these different things are trading, because they all tend to have an influence on other areas of the market. So dollar weakness obviously means a strong euro. The euro is about 70% of US dollar index weighting, so understanding how it's trading gives you a sense as to how the dollar is trading. And then I also like to have the yen futures on screen for similar reasons, right? The yen's another big chunk of the US dollar index. So seeing how it's trading can help. Also, you know, the yen has been a really interesting trading vehicle in and of itself. So we see a bid here as we're starting. The cash open is happening now. You can imagine the bell ringing. If you have any questions, feel free to drop them in the YouTube channel or on the Bookmap Discord. Just tag me in. You can see some more liquidity appearing above us here. This is typically bullish when you see that liquidity appearing above, especially if you start to see some kind of fade below. And you see a little bit of that. But that 431 contract offer up here, that is constructive to see with the price action pushing there. Let's see what we can do to move up above there. We don't have too much institutional passive buying here. Icebergs are about flat. Stops are about flat. So we don't see too many people getting pushed out of their positions to the upside either. So this is more natural buying. This is more buying of the underlying. NASDAQ, quite a similar look there as well. Not quite as much conviction as we saw the larger amount of volume in the S&P futures, but still a pop out of the open. Oil continues to move sideways to higher, still looking pretty constructive. Gold rolling over just a little bit at the open here, but still, again, going back here, this has been a pretty nice little move for gold. So just contextualizing that, pretty flat action and rates. You got to really zoom in to see these things move sometimes. So we'll go back to the S&P here, take a look at the news, see if there's anything interesting going on. There's about a 245 million market on open imbalance to the buy side, perhaps accounting for some of that buying. Commander of the Yemeni Houthi forces has said that the group is ready for a long-term confrontation. Again, the situation there is generally a positive catalyst for oil, but more than that, for shipping rates and for some of those shippers. That was one of the reasons we had a catalyst for that long Zim short squeeze trade. The stock is down today. I've taken off my core at 1466, but I still have runners on. And I'm guarding that with the 200-day moving average. So when we zoom out on this S&P contract here, we can see there's a much larger area of resting liquidity above us as well. These two stacks of contracts over 500, just around 5,000, just above 5,000. So maybe we get to take out our S&P futures 5,000 as well, showing they're willing to, take contracts off even during the pre-market and Globex session. Now you can see we're pulling up the point of control here. That's pretty bullish to see more acceptance up here. You also have CVD, or that cumulative volume delta, becoming more positive. Again, more signs of actual buying happening in this market. We do need to push above this level of resting liquidity right above us, however. It is large enough that it could act a little bit like resistance, so let's see how price reacts to it. And we just gobbled it up. So this makes it more likely, in my view, based on we're seeing more resting liquidity up here above us, that we might make a further push higher here. Maybe we get another 8 handles out of this to gobble up that resting liquidity up here. And you think about it from auction theory, the market wants to transact. And so you've got folks out here saying, I'm willing to sell here, I'm willing to buy here. You have a market that wants to fill those orders, particularly in an order book like today, where it's not super liquid. 40,000 order book depth on the S&P E-mini futures is not super liquid. That makes it more likely that you see these resting bids and offers having a bigger magnetic effect. And the way that effect tends to take place is you have to have momentum in your favor, and then you start to look for that build, like for example in this case on a day where we're moving higher, that build of offers above and above and above, and then you also want to start to see some of the people pulling their bids from below or raising them. So we'll check in with the NASDAQ. NASDAQ's retracing just a little bit here. And the NASDAQ is an interesting beast because it doesn't typically have the same amount of resting liquidity, right? Not only is it a much thinner trader, this is just about, 5.6 thousand order book depth, so like a fraction of the S&P, but also has much less impact from options trading and the hedging flows from market makers. So you just don't see as much. And it's one of the reasons it's a higher beta trading vehicle as well, because there's less of that overall vol suppressing activity happening with all the options trading that happens in the S&P. Let's take a look at oil. Oil is continuing to grind higher here, just that sort of stair-step pattern. Overall looks pretty constructive. This is another one where resting liquidity doesn't tend to be as influential, but when you do see a really big resting bid or offer in oil or the NASDAQ or any of these others, it's worth paying attention to. Because it's more rare, it's more important. Gold moving sideways here after the open. And rates just sort of grinding sideways to a little bit higher as futures move lower. Let's take a look at the euro. Euro's continuing to move higher here. Weaker dollar is generally bullish for equities, so that's one of the reasons it's good to watch this chart. Now, we do have some interesting options activity happening this morning. I like to look at some of the unusual flows. Those flows are, and I'm sure no one would guess this, going into places like Nvidia and Tesla. Pretty unusually bullish flows in both. Sometimes those can help to push the stock price higher because if they're large enough, the dealer hedging activity becomes influential in price discovery. That is to say, if a dealer is selling calls, they've got to buy the underlying shares to be delta neutral so they're not out a bunch of money if those calls perform. You got some downside, maybe some hedging here in Amazon as well. You have some heavy put flow there, about 118,000 in premium paid for the 140s expiring on the 16th of Feb. I always like to look at the equity and ETF call flow because it gives me a sense as to the sentiment underneath the surface when we're trading. When you see really large amounts of volume and premium skewed to one side versus the other, it has a reasonable correlation with how the day plays out. So when you see much more call-heavy activity on the unusual side than puts, that can have an impact on the day being more likely to be constructive, and even led by some of those same components that are having that unusual activity. Speaking of which, about 217,000 of call premium paid for Meta expiring on the 16th, the 405 strike. So again, you know, some of these sort of magnificent 7 stocks getting a pretty strong amount of activity just out of the gate. And in just about 20 minutes, we do get that JOLTS data. My stream ends around 10, but I gave you the playbook in terms of how I look at it. 250K either way is what makes it an interesting day. Okay, and I managed to make that rhyme, so that's fun too. But 250K above expectations, you know, basically 9 million or more, I think that's where you get risk off, rates up. And the other side, you know, if you get 8.5 or lower, I think you get rates down, risk on, you know, a big bid. And that's how I would contextualize it. I think that either way, it could make for a more interesting day. But if it comes right in line, I'd just lean towards moderately bullish because you still have all that hedging and some of it might be taken off, which is liquidity positive. Dan, that's a great question, and thank you for asking it. How much, and for those out there that didn't see it, he asked, how much does SPX options impact ES? And it depends on the day, right? But often it's a pretty measurable impact for a number of reasons. One of which is that if you look at SPX as a contract, it's trading between 1 and 1.2 trillion of notional every day. And about half of that, a little less, maybe around 45%, is expiring in 6.5 hours or less. And about 80% of it, you know, when we're including that 6.5 hours or less, going out 3 days to expiration is where that volume is being transacted. So a lot more near-term opinion being expressed. That not only suppresses vol, but it also has a bigger impact on price discovery than it used to, which is one of the reasons I built the tool that I did, because we see zero DTEs tend to have an outsized influence on ES. So, you know, I've built a number of tools to kind of map out the impact of zero DTEs, where prices being transacted in SPX, but also how that translates to ES levels, since there's a delta between the two. And I would say that, you know, on options heavy days where there isn't an outside catalyst, it's extremely noticeable. Some days it acts like a magnet pulling price right around. Like, for example, if you have a day where calls are much more bid than puts, and those calls are, let's say, 10 handles from current price, and price is in an uptrend, let's say breaking out of the opening range, the 30-minute range to the upside, so you're in an uptrending day, it's very likely you're going to hit that most active call on the nose. And you're going to get a heads up seeing that volume in advance. So in my view, on days where price discovery is driven more by options, it's extremely important to watch. On days where there's outside catalysts that have a bigger impact, it's less important to watch. So for example, yesterday, the Treasury came out with this announcement that QRA they would be lower than what they had projected and lower than maybe what the market was anticipating. Now, obviously, they can upsize that later, and they often do, but that was taken as positive. That came out around 3, and you got a really strong bid from that, which exceeded where most of the options activity was happening yesterday. And that was an event-driven catalyst, right? So that went beyond what was sort of being priced in to those intraday dynamics. So I'd say that on days that don't have that powerful event catalyst, options tend to be setting the tone in the market. A lot of the options activity by default is selling at the money or in the money puts to buy just out of the money calls, and that's net constructive for liquidity. So knowing where that activity is happening, where those algorithms are placing their orders helps us to understand a lot more about what's happening in ES, because a lot of the volume footprint in ES on some days, as much as 60 or 70%, is driven by market makers hedging their SPX positioning. So, Dan, let me know if that helps and to contextualize kind of the impact here. I've written some articles on it on Traderade.com as well that are free to view, that you're welcome to check out. You're welcome. Really good question. So we're just sort of flat here. I think the market is kind of coiling up a little bit in anticipation of jolts. These labor market numbers have been pretty important. So wouldn't be terribly surprised if we sort of chop sideways for a bit here until we get the data. One thing that's important to realize too, when these data releases are happening, liquidity thins out just before, during, and for a little while after, which means it's harder to get good execution. You can have wider slippage. You can have more potential for being pushed out of things if your stops are tight. So it's really important when we're coming up, on these types of events that we aren't in too much size. And in some cases, like for something like this, I don't want to be in anything on a scalp level. Like if I'm intraday trading, I don't need a position on before a binary event. Because that's tantamount to gambling. I don't have an edge. I don't know exactly what jolts is going to be. So I'm not coming into this knowing, oh yeah, we're going to rip 20 points higher. So I'm long before jolts. Like, I don't know. Do you know? Do you know what the data is going to be? No, we don't. But what we can do is we can take positions off ahead of data like this. We can examine the market impact of the data and see if that has a setup that comports to our system. Is there a trade that comes out of this? Like, do we break up and start to see more offers coming above? Do we see more options activity pushing higher? Do we see more of an expression by market participants that they're looking for prices to go higher and a trend that matches that? So the momentum is in our favor. In that situation, I'm more than happy to get long. But into the event, I often don't see any real reason unless I feel like I have some real edge. And even then, I'm not going to go full size, because what's the point? This is the same thing that I see when folks are betting on earnings outcomes. And I'm not talking about putting on something like, selling the put or selling the call, or buying the put or buying the call, where you're just kind of, talking about the vol outcome. I'm talking about directional betting on earnings or other binary events. It's generally just gambling. So it's not how I trade. To be consistent, I've been doing this since 2005, so like 19 years now. To be consistent, I try to remove myself from those types of trades that feel more like gambling. Because it doesn't matter if you're right or wrong. What matters is if you're making money and if you're understanding how you're making money. You have to be able to repeat it next day, next week, next month, next year. This is a business, right? You have to understand how your business works. And the idea is you're taking inventory. If you're a long trader, you're taking inventory that you think is discounted and you're selling it later at a premium, right? Well, we don't know if we're going to be taking this inventory in at a discount and selling it at a premium after jolts. So that's why it's important to be just a little bit more nuanced about approaching these intraday trades too. Let me know if that makes sense to folks out there. If you have any thoughts or questions or experiences you want to share, feel free to chime in. Danny asks how I can, if I can go over how I view the liquidity differential and iceberg indicators on the chart. Sure. Yeah, I'd be happy to do that. So the liquidity differential is showing you where there is a differential between the bid and ask. So that's important to contextualize because it's kind of showing you who's more dominant in the market at that moment in time. Because what this is showing you is the bid and ask liquidity, right? So when liquidity differential is more negative, it's showing you that there's more liquidity that's looking to get out, right? When it's positive, it's showing you that there's more liquidity that's looking to get in. It's a very short-term indicator. For me, I like to see it more at extremes when I'm looking for some kind of move that's reversing or like a breakout, right? So for example, if let's say after JOLTS comes out, it's like a really low number. Let's say it's 8.45. I'd love to see that liquidity differential going very, very high, like 1,000 plus, showing like a lot of flow wants to get into this market and it's maybe becoming less price sensitive, right? Because the more that's banging on the door that's on one side of the trade, the more likely it is that it's going to have to do what the market wants, right? If there's more supply of bids than supply of asks, then the market's going to have to move higher to accommodate that. So that's how I kind of look at the liquidity tracker. I've got it on the subchart on the white line and then on the radial. And so you can see it in both places, and then you can kind of correlate how it may impact price. For icebergs, though, this is both something you can see on chart. You see this 200 here, right? That was an iceberg sell of 200 lots. And then the subchart blue line is the icebergs. You know, for me, and you also have it on the radial here, showing the icebergs over the last 30 minutes, the delta. For me, what I'm really looking for with icebergs and stops is signs that someone's kind of getting pushed out and that we're seeing a change, right? So what I mean is stops are typically shorter term traders that are more price sensitive. So when you see like price moving higher and you get a bunch of people that are being buy stopped out, and you've got icebergs starting to accumulate into that move, that can be really interesting to me, right? That's starting to show you that passive buyers are overwhelming the short-term momentum traders. And typically you can get some continuation into a move like that, just like you can in the opposite, where you get a lot of people that are getting blown out, but now the icebergs are selling into that strength and saying, okay, well, you know, we kind of had our stop run. Now it's time for us to distribute and look for another opportunity. I think that both scenarios can be pretty interesting, but I like to use icebergs with stops rather than outside of just having stops, right? Or just having icebergs. I think they work really well together. That being said, you know, the icebergs are showing you sort of the larger hands in the market, the passive flow. And an iceberg, if for folks out there that don't know, an iceberg is a trade that's large enough that the player wants to hide the total size of their hand, right? So maybe someone wants to transact 2,000 S&P contracts, but they only want to show 100 at a time to not spook the other side of the market. So that's what an iceberg is, and that's why it's important to realize that these iceberg players are usually much larger passive flows moving through the market. So let's say you have a day where icebergs are trading 2,000, 3,000, 4,000 positive delta. That's showing you that over that time frame, whatever you set it up in Bookmap, that there's a lot of accumulation. That's generally constructive, right? You're showing there's short covering or actual accumulation of exposure by larger players. So that tends to be something that's constructive. I like to see it, especially in the first and last hour of the day, because that's when those flows tend to be the more intense. So let me know if that helps, Danny. About 8 minutes out from getting JOLTS data here and also wrapping up this stream. It's 9 to 10 every Tuesday. So definitely check it out. If you're interested in the work I'm doing at Traderade, which is all about helping traders become better, sharing ideas and tools, check us out. We've got a 30% sale going on until tomorrow. You can use the coupon 2-year sale, number 2-year sale at checkout. And you can also get up to 40% discount on Bookmap visiting traderade.com/bookmap. That's traderade.com/bookmap. So we can see more liquidity above us. Again, we talked about the importance of resting offers building in an upwardly trending day. We do have that data print coming out in just about 8 minutes. I would imagine that liquidity thins out a bit ahead of that print. So be careful if you're trading this market aggressively, scalping it. This tends to get a little choppier. And that's one of the things that's really cool about Bookmap is you can see the presence of these different, market participants and how they want to participate. So that heat map is really, really helpful, particularly when you can contextualize it with a bigger picture. Like, where's the volume profile over the last 3, 6, 12 months? Where's the options positioning? Where are options transacting? All that tends to be quite helpful. So look at this. We can see now that our options data is populating with the SPX options visualizer. We've got the hot call translated over here to ES levels up top, and that is in excess of the amount of puts. We've got that asterisk there to show us that the put call ratio favors calls, but also the hot call, or the most active call, is being traded more actively than the most active put. We can also see the warm call, that's the second most active, and the warm put. And these numbers are updated every minute. So this is pretty interesting because it can give you a better sense as to how people are participating and where positions are in the options market. And you add that nuance to the liquidity visualization of Bookmap. And I feel like both together can be pretty powerful. What significance does the large order indicator have when in certain arrangements, i.e. looks like pyramids? So, Big Spark, I think you're asking about the icebergs. Are you talking about the blue pyramids? I'm going to assume that's the case. You can tell me if I'm wrong. But the blue icons are icebergs. If they are above, then that's showing you the size of the sale. If they are below, that's showing you the size of the bid in the columns. Oh, okay. So you're talking about like the cumulative order book and the session volume profile, COB and SVP? So those we're going to talk about separately. Cumulative order book, this is where people want to transact and the size that they want to transact in. The red are offers, the green are bids. Okay, so like right above us, we've got this offer of 628 contracts, or as it was initially put on, 671. You can see it in the heat map. It also translates to this column. Then the session volume profile is showing you where transacting has already happened. So these can be areas that are important, particularly as we go throughout the cash session, seeing where we're building acceptance, where we may have places that market participants are more interested in transacting. Right, so that's resting liquidity. When we're looking at the cumulative order book, that's all resting liquidity. So these are large institutional players for the most part, and this is their orders all aggregated. So all this red here, like that area you mentioned, this is someone who wants to sell here, whether they're closing out a long or entering a short. That's not clear to us, but what we can see is there is that large offer there. And so not only is it visible in the cumulative order book, but it also comes out the heat map And you can see it, you know, in this expression of that outsized liquidity right above us as well. So for me, I look at any order of 250 or more contracts in ES as being significant. On days where the order book is as small as it is like it is right now, maybe even 200 or less, because right now the order book's only 35,000 contracts as we're just 3 minutes out from JOLTS. Let me know if that helps. And so again, we are just over 2 minutes out from JOLTS, about 2 minutes 30 seconds. The forecast is for 8.73 million. My thought here is, you know, we get 9 or more, that's negative for the market. It's negative for stocks and bonds. We get 8.5 or less, that's positive for stocks and bonds. That's kind of how I'm contextualizing it. It's a very simple way to trade it. We are coming into this data pretty well hedged. We do have, you know, consumer confidence coming out at the same time. I don't see that as being as important of a data print unless it's really meaningfully an outlier. But the forecast is for 114.2. The prior was 110. So that'd be a build on that confidence continuing to increase. The market right now trading right at the midpoint. The midpoint is an indicator that pops up automatically when the flows between the puts and calls are relatively equal. And that's exactly where we are right now. And price is sort of pinned there. So this is another way that SPX options visualizer, which will be on the Bookmap marketplace, should be this week, can help you have a better sense as to how options may be impacting the market. Just got about a minute left. If anyone has any questions or thoughts, anything they want to share. And I will be back next Tuesday at 9 a.m. Eastern. Really appreciate everyone tuning in. It's been fun to talk about all the stuff we've been talking about, the technicals, the convergences between options and volume, and sort of putting it all together and how we can trade off of it. And you can see liquidity is thinning out ahead of the event. You see how the heat map has gone lighter and lighter blue? There's less liquidity here as we're getting into JOLTS. This is why it can be a little treacherous to trade this stuff. So I'm going to hang on just for the data print and release, and then I'll hop off just after 10. Got about 30 seconds left. Data is coming out imminently. Just waiting for it to cross my screen here. Obviously, there's a little delay for YouTube as well. JOLTS came in at 9 million. So we got that, that stronger than expected print. Consumer confidence just about in line with expectations. But JOLTS, that's the interesting one. 9.03 million versus an expectation of 8.73 million. You can see on screen the initial reaction is a drawdown in S&P. We also see rates moving higher, bond futures moving lower, pretty much exactly what we talked about. NASDAQ also even more rate sensitive than the S&P, grinding lower here. You do see some liquidity also appearing below, and for NASDAQ, that's decent size. So the dynamics have now begun to favor sellers here. This is not the type of data that folks would have wanted to see if they wanted to say we've got the all clear from the labor market. This puts us at a ratio of about 1.5 jobs available for every unemployed and insured person seeking work, and that is a tight labor market by any definition. So that concludes my stream today. I really hope that was fun. looking at the numbers, looking at the data, modeling what the outcomes might be. So far, so good on that, by the way. I wish you all a great rest of your trading week, and I'll see you next Tuesday, 9 a.m. Eastern.